Good morning, everyone. Welcome to the first Tax Support for Professionals webinar of 2023. My name is Malcolm Pengelly and I'm your host for this morning. Before we get started, some housekeeping points, please. If you've got questions for the speakers, would you please post those in the Q&A and we'll pick those up at the end of each session. There is also a feedback survey at the end of the final session, and it would be fantastic when we get to that point if you could rate the topics, because the feedback's really appreciated. Thank you very much. Ben, next slide, please. We have a really full agenda this morning. The news items are covering various items of topical tax news and what's around the corner in April. Sadiq Hashmi is going to cover the direct tax matters. Marvin Reynolds will cover VAT. Then we have the first substantive session with Chris Holmes and Nigel Giles regarding purchase of own shares and NewCo MBOs, and they'll talk about which is most appropriate when. And on the final straight, we have Matthew Carter talking about R&D tax relief reforms, what's new, what's changing, and how HMRC are tackling abuse. And if we haven't frightened you all silly by the end of that, you've got an opportunity for some final Q&As. Next slide, Ben. And here are the speakers and their contact details. And Sadiq, over to you.
Thank you, Malcolm, and good morning, everyone. Hope you're all well. Let's get started on the news items. Right, so what I'm going to do is just refresh you all on the main changes that are coming in from April 2023. It's just going to be a quick whistle-top 7 minutes on the new stuff that's coming in. So probably one of the most important changes is the corporation tax rate is going to increase. The main rate is going to increase. So from 19%, which it is currently, it's going to increase to 25%. And that's going to apply to all companies that are large. So with augmented profits of 250,000 and above. And it's also going to apply to closed investment holding companies. So this is a huge, big deal, going from 19% to 25%. My colleague Nigel, he's done a great article on this for Tax Journal, and we will send you that link in our email. So I recommend everyone read that. It's very comprehensive, and it goes through all the implications of that 25% increase to 20%. Basically, the 19% still applies to small companies. So for that, the purpose is it's any profits below 50,000. A marginal rate relief applies to companies with profits between 50,000 and 250,000. And the associated company rules are back. So these were the limits, the thresholds get divided by as many associated companies within the group. The big effect of these of the corporation tax rise is that for the first time, it may be more beneficial for business owners to extract profits as a salary instead of a dividends if they're high rate and additional rate taxpayers. It's actually around 1% more tax efficient now. It will be for those within from 2023 for business owners to pay themselves a salary instead of a dividends. That's a huge change. So please read the article. It'll be up on the email. Next slide, please. Okay, so going through some more corporation tax changes. So R&D tax relief changes. The way I like to remember it is that it's good news for large companies and bad news for SMEs. So for large companies, there's currently a research and development credit. The current rate is 13%, that's going to increase to 20%. Okay. For SMEs, the rate on qualifying costs will be cut from an additional 130%, the deduction. It's currently at 130%. It's going to go down to 86%. So bad news for SMEs, good news for large companies. The diverted profits tax rate is going to be increased. It's currently 25%. It's going to go up to 31%. Good news for banks. So the bank surcharge will actually reduce. It's currently the surcharge is at 8%. It's going to go to 3%. Okay, so that's the main corporation tax changes. If you go on to the next slide, we'll cover the income tax changes. So the big news which is coming in, officially it's effective from the 2024-25 tax year, the basis period reforms. So this is all about moving from the current year basis of assessment to a tax year basis. It's going to be effective from 2024-25, but 2023-24 is a transitional year, which gives businesses opportunities to prepare for these changes. So businesses that draw up accounts to a date other than 5th April or 31st March will need to prorate their results in the tax year. This means that some businesses will need to use provisional figures while filing their tax returns. There's a lot of articles on BDO website on these changes, so recommend reading those just to refresh your memory. Okay, some more changes which were announced in the mini budget. The additional 45% tax rate that will now apply for taxable income above 125,140 from April, instead of the 150,000 limit. There was a lot of drama about that when that was first introduced. Okay, and the dividends allowance will also be reduced, which a lot of you should already be heard of. The dividends allowance is now 2,000. It will be reduced to 1,000 from April 2023, and then from April 2024 will be the 1,000 will be halved again to £500. So yeah, so next slide, please. Okay, here's an important reminder of. I'll start with ATED first. So 2023-24 is an ATED revaluation year. We get these once every 5 years. So for the purposes of calculating ATED, the properties, the ATED charge will be based on the market value of the property from 1st April 2022. Okay, so if you have clients which have properties which are close to the ATED thresholds, which is 500,000, 1 million, and so on, if they're close, say the property's values within 10% of the thresholds, we recommend that clients get a valuation on their properties from 1st April 2022, so they can accurately calculate the ATED charge for 2023-24. They've got until 30th of April 2023 to file an ATED return or claim an ATED relief. Okay, moving on to CGT. The CGT annual allowance, which is currently 12,300, that will reduce to 6,000 from April 2023, and then it will be halved again from April 2024 to 3,000. So the rates are reducing. The thresholds are reducing. Okay. There is more favourable CGT rules for disposals by separating spouses or civil partners. This will be particularly useful for properties which are being transferred. So the government's actually extended the period after separation to 3 years to get that nil gain, nil loss treatment, which applies to spousal transfers of assets. I think that's the end for the direct tax update.
Right, it's Chris Holmes here. I'm going to be doing a quick session on purchase of own shares and NewCo MBOs with Nigel. I'm going to do the purchase of own shares, then Nigel's going to take over. Just to say that if you have any questions on any of this, you can talk to anybody in the tax line, any of the tax line consultants. We're all pretty familiar with both of these concepts, and we give a lot of advice. We all give a lot of advice on them. So it just happens to be me and Nigel speaking. Right, first slide. Thank you very much. Right, there's a lot of information on my slides. I'm not going to read through everything, so I'm going to pick and choose the main points. So let's talk about it. Right, first thing to appreciate about purchase of own shares from a tax perspective is that purchase of own shares is both a distribution in law and it is a disposal of an asset. So technically, it falls both within the income tax regime and the capital gains regime. Yeah. Section 37 tells us that the income tax treatment has priority because it basically says we ignore any consideration for capital gains purposes for which income tax is being charged. So income tax takes priority. Right. So the purchase of own shares legislation at 1033 is important because it tells us that in certain circumstances, it becomes an exempt distribution for income tax, which means if it's no longer subject to income tax, it falls back within CGT. So that's the whole point of getting the purchase of own shares to meet all of the conditions of 1033, it's so that you can get the capital gains tax treatment. I've put a note here. It's that this technically applies for companies as well. It's just normally we don't corporate shareholders. It's just normally corporate shareholders can rely on 931A, which is the exempt distribution rules. Now 931A actually does exempt all distributions, but we've got to bear in mind that where there's an actual disposal of an asset like there would be here, it would still have a capital gains on the disposal. So a lot of companies might prefer an income treatment for the distribution, take the distribution treatment because that means it's exempted on 931A and they don't then have a capital gains. Or we need to think about different ways of doing things anyway. So that's the point there. Right, stamp duty. The only reason I'm saying this is primarily the difference between purchase of own shares and NewCo MBOs from a tax position. Stamp duty is payable for purchase of own shares only on the shares that are being acquired back by the company. I'll let Nigel talk about how the NewCo MBO works, but from a tax perspective, that's where the additional costs lie. Right, next slide, please. Right, let's look at the legal conditions first. Because it is a distribution, all the normal rules for a distribution have to be met in law. So we have to have distributed reserves available. We need to have relevant accounts prepared so we can check that there's sufficient reserves, etc., etc. So we need to meet all the conditions to make sure it's a lawful distribution. That's the first point. The second point is that the revenue have through an interpretation of case law, actually for the word sale, but that's a long story. Considered that the word purchase in the Companies Act means it needs to be a purchase for cash. So for cash paid up front. So as far as the revenue are concerned, to be lawful, there has to be a cash payment in full. So that's quite that's quite important because often we find we're trying to do these and we haven't got sufficient cash. My last slide, I'll be talking about what we can do if we haven't got enough cash, so I'm not going to go into that details here. But we do have a quick war story. I had a case where an accountant called the tax line up, and in a bit of a panic. His client was a high street shop owned by two individuals. It had a franchise. It was an optician's. It had a franchise from one of the big companies, and one of the directors, the franchisor, found out that one of the directors had been selling been buying glasses from another source. And they basically turned around and said, if you want to keep the franchise, he has to go. So unbeknownst to the accountant, this was all unbeknownst to the accountant, they basically gave him £500,000 to walk away, saying it was a purchase of own shares. The only documents the guy signed was a resignation of a director and a stock transfer form. He didn't sign anything else. The accountant comes along at the end of the year, goes, we haven't got enough reserves. What's going on? We spoke to a lawyer and basically there was nothing that could be done. We had no reserves. The actual purchase of own shares was void. That meant that, the better translation was it was void, and which means the shareholder was still, the director was still a shareholder. which meant a difficult conversation was had to have with the franchiser. And then what was the cash? Well, the better thing for the cash is it was a loan, and therefore it could be, we could do something with it later on. Worst translation might be it's a distribution. It's one of these things. It's really of course, if it was a loan, I think we worked out we had a month before 455 charge to sort it out before 455 charge would apply. So it could be a real mess. So you need to really take a lot of care over these things. You do not want to end up with a void transaction. All right, talking about the tax, there's a unquoted trading company. The definition of trade here is that it needs to be wholly or mainly a trading company. So it's just a 51% test. When I'm reviewing people's clearances for purchase your own shares, as I often do, one thing I often pick up is they start talking about the 80% test, you have for SSE and BADR. It is not that test. It is a wholly or mainly test. The other point to bear in mind, which I think a lot of people overlook, is the condition B. For there is this override for purchase your own shares that says if the only reason you're doing it is so you can pay an IHT liability, then we'll let you have the capital treatment regardless of whether you've met all these other conditions. So you don't need to go through all these conditions. Now I have to say, in practice, I've not seen that myself. I know a colleague's seen it a couple of times. It doesn't happen very often, which is why we keep forgetting it's there. But it's worth remembering if you're talking about it, from an IHT, if you're talking about it for that purpose. Next slide, please. We're going to go through all the condition A's now. Next slide, please. Right, lots of conditions. These are most of them here. Benefit of the trade is the main one. This is one where it is normally a justification. Disruptive. Directors in dispute, whatever it may be, something you want to exit the business is perfect. As a shareholder, is perfectly fine. But often we do need to look at that benefit of a trade and make sure there really is a benefit. I say it's not normally something we struggle with, but we just got to make sure it's there. It's a slightly harder test than not for tax avoidance, which is one of the other things. Then we got other conditions here. Have to have held the shares for 5 years. I've seen people trying to put in arrangements whereby they sort of stall the buyback. They contract for it now, but they sort of stall it by put and call options for a few months so they can meet the 5-year condition. That they manage to get clearance, which has always surprised me. If you do it right and you explain it right, you can get clearance for that one. But I say I'm always a bit skeptical. The two that often catch us out, or we often see, is the requirement to reduce your shareholding by at least 25% and must not be connected. And these things take into account shareholdings held by your associates. So what those mean is that more often than not, family-held companies fail this test, because when you look at yourself plus the rest of the family, you don't meet the test. So family companies do often find purchase your own share option routes difficult. So lots of reasons. Next slide, please. All right, here's another one. I've seen quite a few big purchase your own shares being cancelled because of this employment-related security charge risk. Technically, when you are calculating for employment-related security charge, there is a charge if you sell your shares for more than they're worth. And for ERS purposes, that value should take into account a minority discount. So if you're selling 5% shares, you would expect those to be 75% of the value. The discount is 75% or whatever it may be, sort of thing. So but quite often when you talk about purchase your own shares, people are saying, well, I've got a 50%. I own half the shares. I want 50% of the company's worth. Well, without taking a discount, or 25%, I want a quarter of the value of the worth of the company, and they don't value the shares. Now, you can imagine why the revenue don't like to do that if the person acquired the shares at a discount in the first place, so they paid the unrestricted market value, or the restricted market value, or something like that at the start. You can understand why they would insist that a discount on the way in and a discount on the way out. In practice, when I've looked at these things, the couple of times we can normally get around it is either because the shareholdings were that old, they predated employment-related securities, so it didn't apply, or we were able to turn around and say, well, actually, these shares were acquired based on a full value of the company. So 4 shareholders put in £50 each and bought 25% of the business at the stage 1. So they actually paid full value up front. So why shouldn't they get full value on the way out? And the revenue tend to take that, tend to accept that point. Although there's no guarantee they will, but that is a thing. But for big numbers, clients often, I've had, I say, 2 or 3 big ones in the last couple of years where we decided not to do a purchase your own shares and go the NewCo MBO route specifically because of that. Clearances, 104. There is a specific clearance for purchase your own shares, section 1044. This is perhaps one of the best clearances there is, because it actually says, yes, we agree it works, or no, we agree it does, or no, we say it doesn't. So if they say yes, as long as you've made full disclosure of all of the facts, then you can rely on that clearance. And actually that means the tax advice we as advisors have to give is doesn't need to be so robust, because we got the revenue saying yes. So it does sort of often negate such a complex tax report. We also own a 701 clearance and all these sort of things. If you're writing anyway for the cost of 3 lines of text, why not throw it in there? It doesn't require any extra explanation. The other thing I remember is that 60 days after the payment has been made, the company is obliged to report to the revenue that it has made the payment, and to explain why it believes that section 1033 applies, why the distribution is exempt. Now, if you've got a clearance, that's easy. Because you could just say attach clearance, and that's fine. But if you haven't, I've got a case now where we haven't got time to get clearance up front, so we're talking about in fact, we've still got to do the work, but we'll reflect it in the disclosure afterwards. So yeah, next slide, please. Right. What happens if you have insufficient cash? This is my last slide here. So, what happens if you have insufficient cash? Well, there's some obvious things to do. One is you can just borrow cash, from a bank or from other shareholders. So if you've got the cash, you're going to make it out. You can also, we do often though see that the shareholder being bought out often actually lends the money back to the business. Now, what we have to bear in mind here is that the revenue expect cash to be paid, so we do actually need cash flowing out of the business and then back in, preferably with a pause overnight. Now, that may mean that you need temporary finance, but some companies find it much easier just to get overnight borrowings than more long-term borrowings. Or another shareholder might be willing to lend it for a short period. So there's a couple of ways of getting cash in. There's actually another one which I meant to add, but I was too late for the slides going. That's because I've got a case at the moment where they're doing exactly this. They're actually issuing additional preference shares to one of the existing shareholders. So a shareholder is subscribing for £8 million of preference shares. The extra cash in the business will partly go towards the repayment of the purchase of shares of 2 million to buy out one of the founder shareholders. So they're getting cash in that way. I should say in that particular case, they also haven't got enough reserves, so they're doing a capital reduction on the share premium account to put capital into reserve, so they can then make a lawful purchase of own shares. So there's options around that as well. Right. But if none of that works, a common solution that people see, although I have to say we don't necessarily recommend because they're just awkward to do, is single contracts with multiple completions. This is where you you enter a single contract, the company enters a single contract with the shareholder to buy their shares. However, the completion of that contract goes over a number of dates. So, multiple dates, could be 2 or 3 installments, could be longer. So that's something to that's often thought, but it can be confusing because it can be, there are risks there. How can you guarantee that the future date you are then going to have the cash, you are going to have the reserves? What caveats do you have in there? And the legal documentation needs careful reading. I read I was looking at a legal a sale and purchase agreement last week on one of these, and the buyer was the company was given the right to decide to actually, I think it had the option to buy. It looked more like an option agreement because it didn't. The second part of the deal didn't happen until they actually said, yeah, okay, we want to complete. So it was all. There's a lots of there's a lots of risks there. The other problem with it is around the 30% test. This can be worked around. The 30% control test. Now, technically, this is the revenue. The revenue have raised a policy decision on this, and they've looked at this and they say that technically, the as the shareholder, even though technically you've sold the shares to the company and it is now the beneficial owner, you still as legal owner are able to exercise the votes, but because you physically vote, admittedly at the direction of the company, which means you probably don't, then the fact that the legal votes are yours means that that's part of the control test. So if you still own, after the first installment, 30% of the shares, you fail the control test. Now, the revenues say the way to work around that is simply, cancel the votes attaching to those shares. So that's something we might often see when you do multiple completions. It's another complication. And the other thing you need to do, of course, is multiple returns 60 days after every completion. Jeff had a case many years ago where I think they did it monthly over 3 years. So they had 36 reports out to send in, which was just hassle. But anyway, that's the options. I think I finished mine. Hopefully I've not overrun too much. And can I pass over to Nigel?
Chris, good morning, everyone. Hopefully you can hear me. Right, I'm now going to talk about new company management buyouts, or NewCo MBOs, as they're known. NewCo MBO is basically an alternative approach to achieve pretty much the same aims and the same tax result as a share buyback. If it's implemented correctly, the departing shareholders should expect to get capital treatment for their cash proceeds, and the continuing shareholders should effectively end up in the same tax position as they were before the transaction took place. As a general rule, NewCo MBOs are probably a bit more flexible than share buybacks and can apply in a wider range of exit scenarios. I think there's probably 3 typical scenarios where a NewCo MBO might apply, where a company share buyback wouldn't be applicable. These would be, firstly, where there's insufficient reserves to meet the company law requirements of a share buyback. Secondly, where the specific requirements for capital treatment for the departing shareholders don't apply. Chris has alluded to family companies. There's the 5-year rule. And the third scenario is possibly just where the commercial deal is for deferred consideration to be part of the sale proceeds. As a general comment, NewCo MBOs do lend themselves well to family company arrangements, but it's not exclusively the case. To give an example, I recently advised on a NewCo MBO involving 2 young French lads who'd set up a UK company as a sports betting company. Phenomenally successful over the first 2 years of trading. But basically wanted to do different things. One of them wanted to carry on, and the other one wanted to go off and start a new venture elsewhere. They couldn't do a share buyback to get rid of the exiting shareholder for 2 reasons. Firstly, the 5-year rule didn't apply, and secondly, they also wanted to defer consideration. So for the continuing shareholder, he actually wanted the other guy to stay around for another 12 months. But NewCo MBO worked very well for them. Administrative requirements are not dissimilar to purchase of own shares. You'll have the professional involvement. There'll be accountants, the accountant stroke tax advisor, lawyers. There's a company secretarial piece of work here, valuation costs. I think overall professional costs are probably not dissimilar to those for a company share buyback. Where you do have a pure additional cost in the case of a NewCo MBO is on stamp duty, because basically the way the mechanics of the NewCo MBO work is that the new company is going to be buying the 100% of the issued share capital of the target company. So in effect, the chargeable consideration for stamp duty purposes is the whole of the value of the target company. Whereas in the case of the share buyback, the chargeable consideration would just be what's paid to the departing shareholders. Put this in context though, stamp duty applies at 0.5%. So if you're talking about a company worth between 1 million and 10 million pounds, the stamp duty involved is between 5,000 and 50,000 pounds. So although it's an extra cost, it's not normally seen as a deal breaker in these kind of transactions. Could I have the next slide, please? All right, just going to talk very briefly about the mechanics of a NewCo MBO transaction. So start point, step one is the shareholders are going to continue, will incorporate a new company. The initial allocation of shares isn't particularly important. What is important is that after the transaction, they've got the same shareholders in relation to each other as they had beforehand. So there's no transfer of value between them. Next slide, please. Yep, so step two, new company will buy 100% of the share capital of target company. For the shareholders who are leaving, they'll receive cash. The cash will be payable on day one, but they won't physically receive it until afterwards, but I'll explain this on the next slide. The continuing shareholders, they'll receive a new issue of shares, and also there may be the departing shareholders may take a small amount of shares as well. Continuing shareholders will receive shares. Basically, what we'd be looking to achieve here is that the share for share exchange rules at section 135 of TCGA 1992 apply. And if that's the case, then the new shareholders will stand in the shoes of the old shareholdings for all tax purposes. For example, business asset disposal relief. If section 135 doesn't apply, then what would have happened is you'd have disposed of the shares for a consideration in the form of NewCo shares, and that would be a CGT disposal. And clearly, we want to avoid that. So it's important that we meet the requirements of section 135. Probably the key criteria here is to satisfy HMRC that the transaction is taking place for bona fide commercial reasons. And what you can do is to apply for an advance clearance under section 138 of TCGA 1992, and basically you set out the commercial rationale behind the exit of the shareholders, and to get clearance in advance from HMRC that they agree that the relevant criteria for section 135 are all met. Could the next slide, please? Step three, basically on day one, NewCo hasn't got any money. So the idea behind the NewCo MBO is that the departing shareholders who are due to receive cash, the consideration is left outstanding on account. But as soon as the target company becomes the owner of, sorry, as soon as NewCo becomes the owner of the target company, it will then pay up a dividend. Target company will then pay up a dividend to NewCo to enable it, put it in funds to pay off the initial consideration to the departing shareholders. In practice, that process can be done very quickly and certainly won't take more than a few days. And that dividend between the two companies is a tax-exempt dividend, providing HMRC are happy this is not for tax avoidance purposes. Could I have the next slide, please? Clearly, funding this whole transaction is important. And if the initial consideration can't be paid on day one, or if it's a deferred consideration payment, in an ideal world, what you'd be looking to do is to pay the departing shareholders' consideration out of reserves, existing reserves, or whether there's deferred consideration out of future growth of the company. And if you can pay it up as dividend, then that's the easiest mechanism to use. Sometimes we see situations where the trading company has to borrow to fund the buyout. One thing to watch in that situation is HMRC have a view that section 455 could apply in that situation. There is some revenue commentary at CTM 61550, and certainly although it's a contentious point, our view is if your borrowing can be avoided, that would be preferable, or at worst, if you do have to make short-term borrowing to try and get it all paid off within 9 months at the end of the accounting period, so we don't get into section 455 issues. As far as the tax position goes for the departing shareholders, clearly the initial consideration, CGT is payable on day one. Any elements that are left outstanding, that's still payable on day one. There is a mechanism under section 48, should for any reason they not receive their full consideration, you can make a claim under Section 48 for the CGT to be recalculated based on what you actually did physically receive. In deferred consideration situations, what you may see is that the deferred consideration takes the form of security, which would typically be a loan note. In that situation, the CGT charge, if Section 135 applies, the CGT charge may not arise until the loan note or replacement security is disposed of. Now, there may be situations in that scenario where it may be preferable to pay all the CGT on day one, because from a BADR point of view, if all you've got left when the deferred consideration is payable is a loan note, that may not be BADR qualifying. So there will be scenarios where it would be preferable to pay all the CGT on day one. And what you would do in that situation is to elect out of the share for share treatment. There are mechanisms to recover the tax CGT in the event that the full consideration doesn't become payable. Mentioned Section 48, where the deferred consideration, say as an earn-out arrangement, is unascertainable, then there's loss claim under Section 279A. Now, the thing to bear in mind with loan notes, and I think we've mentioned this on the slide, is QCBs, qualifying corporate bonds. The way that works is the gain's frozen. So you wouldn't be able to adopt those mechanisms in the event that the CGT becomes irrecoverable. So for whatever reason, the loan notes can't be repaid. You may still end up, if you've got a QCB, with a CGT charge, even though you haven't actually got the final proceeds. Next slide, please. Finally, just a few additional points. As mentioned on the slide, there's nothing preventing the leaver staying on as staff, directors or consultants. In fact, we see that quite commonly. There's usually some sort of handover. You know, the founders like to stay involved. Sometimes they want the founders to stay involved just for a brief period. Employment-related securities, the valuation points that Chris mentioned, these shouldn't be particularly in point, because it will basically dispose of the whole of the company. One thing we prefer to do as a sort of belt and braces measure is to get for the continuing shareholders for a Section 431 election to be made. Clearances, I've mentioned Section 138, and there's also transaction securities here. I think following on what Chris was saying, I think when there's cash coming out of the company reserves in capital form, HMSA always look quite closely to see if transaction securities applies, and clearly if it applies, then the capital distribution will be recategorised as income. There are carve-outs, but these may not apply in family company situations. So what we would normally do is do a 701 clearance where the carve-outs don't apply. And as Chris mentioned earlier, we would do that on the same letter as the Section 138 clearance, because they're pretty much asking the same thing. 701 is talking about whether there's tax avoidance motive, and 138 is talking about bona fide commercial reasons. Comparisons to the purchase of own shares. Well, this is a straight disposal, so we don't have the restricted position that you have for purchase of own shares. There's no 5-year share ownership rule. There's no requirement for the payment up front. The bona fide commercial reasons test, it's probably a slightly wider test than the trade benefit test that applies for purchase of own shares, because the trade benefit test is focusing on what is the benefit of the trade of this transaction by these shareholders exiting, and it's talking specifically about the trade. So arguably the bona fide commercial reasons test is a lower hurdle. There's no connection test and no fixed requirement for the amount of shares to be disposed of. Although I would say for the bona fide commercial reasons test, if the departing shareholder is looking to retain a significant amount of shares, you're probably going to have an uphill struggle to persuade HMRC that there's a bona fide commercial reason anyway. Ideally, we would be looking to dispose of most of their shares, if not all, preferably all of them, to be honest. Sorry, excuse me. Finally, just on practical requirements, there is a tax advice piece here. There's a tax report, step plan clearances. You will need to involve a lawyer. There should be a sale and purchase agreement. There may be a repayment schedule to be agreed between the parties. There may be other sale requirements to be agreed between the parties from a legal perspective. company secretarial. BDO's company secretarial team are very experienced in dealing with these types of transactions. Would be happy to help. There's a valuation piece here, just because HMRC are always on the lookout for, always wary of anything that comes out in capital form that they think there might be an income tax angle. Implementation is really important, and this is, as Chris mentioned, with the share buybacks. You really need to get the documentation right, or there could be some unexpected tax consequences. And finally, just the last thing to say is what you will have is a corporate group. At the end of this, you're going to have a holding company and you're going to have a trading company. Have a subsidiary company sitting underneath it. This isn't necessarily a bad thing. And we find in practice that people, you can rationalize this back into a singleton company. You can hive up the trading assets, and you should be able to do that with little no tax cost. But in practice, we find people don't necessarily want to do that. There are uses for a holding group structure. And that's it. So I hope you found my and Chris's contributions helpful, and we'll be happy to take any questions at the end.
And, surprisingly, this is the end of their session. We do have a couple of questions, and we will try and reconnect to Marvin after the questions on this session. So hopefully we'll be able to go back to him. But Chris, first question to you. Are spouses who have separated still connected for the purposes of the purchase of own shares legislation?
Is it specifically for purchase of own shares here? I was actually reading that as part of the divorce thing that Sadiq was talking about. But yeah, purchase of own shares. I don't believe that it's the normal definition. So I guess at the point that they are separated, they're. I'm trying to think what the definition is. It does talk about spouse, doesn't it? But can I check that one and I'll confirm in the final Q&A?
Yeah. Fantastic. And if whoever posted that one wants to follow up further, they can always give Chris a call. And one for Nigel. I think this says if the leaver leaves a debt outstanding, it says in the target company, but I think the debt must be in the new acquiring company, and then you pay up a dividend to the NewCo. Is there any anti-avoidance that might catch that? One for Nigel.
I don't think there's. I mean, what you were dealing with is the clearance, is the revenue. When you present the clearance application, you will explain to revenue the full transaction. The HMRC are familiar with these transactions. So this is basically a short-term debt over a matter of days, and HMRC are happy that what HMRC are looking for is that there's a commercial reason for the exit of the shareholders. So there shouldn't be an any additional anti-avoidance outside the Section 138 and Section 701 that you would get covered by the clearance. Hopefully that answers that question.
Yeah, and I think, again, not sure who raised the question, but if there was a debt in the target company, then presumably the target company would just pay it as and when. If the company owed money to the exiting shareholder, and if the exiting shareholder owed money to the target company, presumably it was already in Section 455 anyway. So hopefully we've dealt with the question, but if not, if whoever raised it would want to follow it up with Nigel, I'm sure he'd love to deal with the question. And one further one on a NewCo. Oops, moved up the page. Can a NewCo structure for a husband and wife company if the wife wants to retire or do other things? So can we use the NewCo for the wife to exit when it's a husband and wife company? Bearing in mind, the husband will then presumably control all of it.
Yeah, it's theoretically possible, but I think I've certainly heard tale of this being accepted in the past. I mean, the issue, of course, is the bona fide commercial reasons, and you've got to present a pretty good case as to why the business will, what the business case is for the exit of the wife going to do other things. It's theoretically possible.
I've done it before, at least once, where the revenue was certainly curious over why was it just one of them going, and you had to justify the commercial rationale for it. The fact that she was genuinely retiring and leaving the business helped, The fact the husband was staying involved and wanted to stay on as shareholder, and there was valid commercial reasons for doing it. He was younger and this sort of thing. I think she was ill, so there's clear reasons why they were in different categories. That made it possible. Sorry.
Excellent. Thank you all for your questions. They're really great.
Morning all, hope you can hear me. So yeah, I'm Matt. For those who not come across me, I'm an R&D specialist here at BDO, and this kind of part of the session is to talk around kind of a whistle-stop tour of the many changes that are coming in for R&D tax relief come 1 April this year. And the bigger picture here is that the government and the policy level has been looking over the last couple of years to reform the R&D regime, primarily, in their words, to target abuse and fraud. But as you will see as we kind of go through these slides, it will generally make the regime a little bit less beneficial for a lot of companies, and a lot more onerous in terms of admin and compliance. So yes, so a reduction in rates, Sadiq kind of went through a little bit earlier, but broadly from 1 April this year, the SME rate of relief effective, if you're a profitable company, it goes down from 25 to 22, 21.5. And if you're a loss-making company, that's where the changes really bite, and that is a reduction in your credit from 33% effective to 18.6. If you're a large company, yes, the rates have gone up, which is good news. And this is all in the grand plan of policy level to align the two schemes. And we'll talk a little bit about that at the end. Next slide, please. Yeah, so aside from the rate change, other reforms in 2023, yeah, so they're listed here, but I'll go through in a bit more detail. So data and cloud computing costs are in. It's an extension of kind of the rules there and qualifying costs. Pure maths is also in, which who knew there's some people doing that and claiming R&D credits, or will be claiming R&D credits. And then we've got the bigger piece, the headline catching stuff around refocusing R&D support towards UK-centric activities and abuse and compliance, and that is the kind of more information, more forms to submit to HMRC alongside kind of wider inquiry changes. So yes, all these changes are coming into effect from 1st of April. Some of them are for periods starting on or after, and some are just from 1st of April. So I'll mention those as we go through the detail. Next slide, please. Yes, so refocus of R&D relief towards UK is broadly now the exclusion of any overseas costs in R&D claims from 1st of April. So this is for external costs. So if you're claiming any subcontractors, those costs need to be taking place in the UK, and likewise if you're using externally provided workers or EPWs, then this will be limited to EPWs that are within the UK pay-as-you-earn NIC net, which is in practice I think going to be very tricky, because as a company you will not be asking your staff providers, your agencies or your personal service companies that you engage, whether they employ people and pay pay-as-you-earn NICs on their salary. So I think in practice this is going to be really tricky to kind of look at when you're making claims. So all external expenditure will be restricted if it's overseas, unless it is falling into this new definition of qualifying overseas expenditure, so QOE. And definitions here, but it's broadly expenditure undertaken outside the UK where you've got conditions that mean you can't do it in the UK. The conditions are present in the place you're doing it, which is where the undertaking is, where R&D is being undertaken, and this is the key piece, that it would be wholly unreasonable for the company to replicate it in the UK. So there is a bit of draft HMRC guidance here, which is not particularly useful, as it kind of highlights a very easy case, and that example is a company making sensors, volcano sensors. They can't test the volcano sensors for obvious reasons in the UK, so they need to find an active volcano elsewhere in the world to do that testing. That is fairly clearly wholly unreasonable to happen in the UK, We don't have the conditions in the UK to do that, so that's a clear in. Another example is for regulatory reasons. So if you develop a drug in the UK, that drug needs to be, for regulatory reasons, tested or whatever else overseas. That would also be in, but this will be the piece that makes most spend fall out in the claims that I see, is it excludes most cases where it's just cheaper or there's more readily available workforce or people overseas to do. So a clear example of that would be coding. A lot of coding gets outsourced to overseas purely because there's a demand out there for it and it's often cheaper. That would immediately fall outside the claim for 1st of April this year. But this doesn't extend to every cost outside the UK. There are consumables sourced overseas which still qualify, and overseas staff can also continue to be claimed as long as they're employed by the UK entity. Next slide, please. So there's obviously a raft of things companies can do to think around this. Whether R&D claims can be made in the territories in question overseas is one that I'm commonly seeing a lot of clients asking about. There are R&D regimes around the world. A lot of them are fairly similar to ours, but a lot aren't. So it's just understanding what the conditions are and how that also impacts your UK right to claim R&D as well. And also whether you can restructure to onshore the R&D. So whether those overseas people, you can use UK people instead. But likewise with all of this, and if you want to make a branch overseas, there is obvious other impacts here, which you need to look at from a tax point of view, and also legal and regulatory as well. So complex, but I think it can be done in some cases. So next slide, please. One of the things that is good coming from these rule changes is the cost of cloud computing used for R&D are now qualifying costs from 1st of April this year. It excludes servers or data storage, but can include the cost of data itself. This will be very useful in kind of software or fintech companies, and there is a rule here which is kind of similar to the consumable costs, in that if you are buying a data set and that data set is then provided in your trade or service after the R&D, that is excluded. So there's a couple of kind of catches there, but on the whole, a good thing. Next slide. And then yes, this is one I don't think I'll necessarily see in practice ever, but pure maths was excluded from the R&D qualifying criteria before 1st of April this year, and from 1st of April it will be included. We'll see if that actually comes to light in anything that we see. Good news nonetheless. Okay, next slide, please. So this is the area tackling abuse of R&D where the reforms were mainly meant to sting, and it will do. So we've got more requirements coming in. I'll go through a couple of them in a bit more detail, but broadly, R&D claims will need to be digitally filed through an HMRC gateway from accounting periods ending on or after 1st of April. That's a crucial fact. There will be a notification requirement for new claimants or claimants that haven't made an R&D claim in the last 3 years. And that is, in the year that you are looking to make an R&D claim for, you need to notify HMRC through an online form 6 months before the end of that accounting period that you intend to make an R&D claim. Now, this is a huge change because, as most of you probably know, you can make a retrospective R&D claim at the moment for the open accounting periods for tax purposes. That will change from after 1st of April this year, and I think that will catch a lot of people out. There are also a lot of new factors here which will make it basically tying the R&D claim more closely in HMRC's visibility to a senior person at the company and the agent, the person doing the R&D claim in the first place. And this is all with the goal in mind of highlighting the boutiques out there that are really abusing the regime and basically making HMRC's life a lot easier in terms of targeting those abusers. And yes, there's a lot more information being provided. I'll just go that. Next slide, please, Ben. Thank you. Yes, so this additional information required by HMRC will be for accounting periods started on or after 1st of April this year. And this is being submitted through an HMRC portal and questionnaire, basically. The beta version that we've got access to is clunky, to say the least. It involves many pages of information, clicking through, saving progress, and there is at the moment no interface between tax software and this portal yet, which makes it's just another step. And the information required, you can see, is pretty vast compared to what you currently need to submit with an R&D claim. We've got things we usually include, like the UTR, pay as you earn reference is a new one, VAT number is a new one, the contact details for the person in the company who's the main R&D contact is another new one, agent reference number. If you go on to the next slide, there's more. And yeah, this is the sort of stuff we tend to submit alongside an R&D claim anyway, so it isn't particularly new. But splitting qualifying expenditure between direct and indirect costs is a new thing, which introduces a bit more complexity and work. And yeah, project descriptions. And if we go on to the next slide, HMRC are now being quite prescriptive in the number of project descriptions that are submitted alongside the R&D claim, including the pay as you earn scheme reference for EPWs that are external to your business. I honestly think in practice this won't happen. And I think EPWs being part of an R&D claim will probably fade pretty quickly, because I can't see many EPW providers providing that to customers. So all in all, that's a lot more information to provide. It is going to be submitted in a clunky online form. And interestingly, we as BDO recently did a survey of mid-market companies in the Central South region, which is where I'm based. 70% responded saying the last R&D claim they submitted no documentation to accompany it. So from 1st of April, that is not a valid claim, and HMRC are well within their right just to refuse it. So that is going to be a really interesting point going forwards that I think, yeah, we need to be making clients aware of pretty quickly. Yes, next slide, please. And then, yeah, just a bit of what we're seeing currently in the market in R&D tax credits and looking forward. So HMRC made a big fanfare about recruiting 100 new R&D inspectors, probably about 18 months, a year ago now. They're now fully operational and up to speed in relative terms, and we're seeing a lot more HMRC activity, and that is both through nudge letters. So those are kind of informal approaches from HMRC, just saying, check your R&D claim, you saw it's right, ranging from those to full-on R&D inquiries. We're seeing a lot of increase here, and a lot of other accountants coming to us to help them out on inquiries, where, and there's kind of three main areas here, but it's kind of lack of evidence. Are they doing R&D? Are they not? Have you submitted the right information alongside claims? Whether things are capital or revenue in nature is another theme that we're seeing, and whose R&D is it is a kind of third area, mainly sparked from recent case law around Quinn and Haddy. The key here is in any case of having an HMRC inquiry is engaging the HMRC and providing kind of the technical reasoning behind a claim. We've successfully helped out a number of clients here, so if you do have any sticking inquiries or just would like help at all, please do get in touch. We're happy to help. And finally, if we're just running a little bit over time, the future of R&D tax credits, there is a consultation at the moment open around potentially merging the R&D tax credit scheme for SMEs and the large company scheme together. I can't see that happening anytime soon, but that is the kind of where we're looking down in a couple of years down the tracks. So I think that's all from me. Have you got any more questions? Lovely.
We do have one, Matt. Says, should accountants continue to submit R&D claims stroke reports with the CT 600s prepared by other R&D specialists that the client has appointed?
That is a big question. We as BDO do and don't. I think everyone will know on this call we now have a professional conduct in relation to taxation, which means we need to make sure there's a sustainable basis for submitting these R&D claims within a tax return, regardless of who's prepared them. I think if they're a legitimate kind of firm that have provided the R&D advice and it all looks kind of kosher from a review from a professional point of view, then I don't see why not. But likewise, if it's someone claiming for something that clearly isn't, I think we've really got to be challenging there. And then, yeah, I don't think we should in that case.
Okay, fantastic. Chris, I think, has got the answer to the spouses.
To the associate persons, yeah. I should say, I thought I'd just go through the whole of associated persons because it's I might be slightly misleading. Right, it's very quick. It is spouses living together. Spouses is for partners that are living together. So if they're separated, they wouldn't. The other point I wanted to say was actually the associates, as far as other individuals concerned, is actually young persons only. So a young person is an associate if they're under 18. So so we've got to look. So we're looking at spouses, minor children, and then there are various, there's various rules about connected companies and such like. So it isn't your general, your wider what we normally say associates for this purpose. But I just want to make sure you understood that, and I didn't slightly mislead you with what I said earlier. So thank you very much.
Lovely. We have got a survey poll for you, which I think Ben has now launched, which is fantastic. Please do rate each of the sections, and there's a final one at the bottom which asks. We've got an annual seminar, all-day seminar on Thursday, the 22nd of June, 2023. And it would be good to know if you would like to come along to that one in person. So we're very keen to have your answer to that one. In fact, we're very keen to see you on the day. And one final point before we close, our next webinar will be on the morning of 23rd of March. It's covering off anything exciting that comes out of the budget, or even perhaps a few things that are not quite so exciting. But the vast majority of the session will be a property update, including ATED, SDLT, VAT, and anything else that's property related. But it'll be topical really to comment on what's happening in the property market at the moment. Life is getting a bit tough out there. So look forward to talking to you about that one in March. In the meantime, thank you to all the speakers. It was excellent. Thank you very much indeed, Gremlins permitting. And we'll look forward to seeing all of the audience again in March. So thank you for completing the poll and have a great day. Thank you very much.